The unwinding of the Japanese carry trade has been baked into the market for 30 years, but because it didn't happen until it didn't happen, nobody cared much. People don't react to government debt because it doesn't affect them until it does. The financial crisis of 2008 was solvable by the federal government because there was faith in the federal government, and there was faith in the federal government having the firepower to extinguish the problem. So we're trying to service $35 trillion in on-balance sheet liabilities and $100 trillion in off-balance sheet liabilities with a budget that is itself in deficit $2.5 trillion a year. We don't care because the trap hasn't been sprung. The Japanese didn't care until last week.
In the 1970s and 1980s, Japan's economy was a global powerhouse, renowned for its export strength and cutting-edge manufacturing quality. The Nikkei 225 stock market index soared to an all-time high in late 1989. However, despite still being the world's third largest economy, the Nikkei didn't reach those highs again until earlier this year, and is currently experiencing a lot of turbulence. This stagnation is largely due to demographic challenges and increased competition. Japan's population is both shrinking and aging, with one of the highest life expectancies in the world, declining birth rates, and minimal immigration. Meanwhile, countries like China, Korea, and much of Southeast Asia have emerged as formidable, cost-effective manufacturers. Similarly, the US has seen a gradual decline in its long-term economic growth, with its 10-year Treasury rate trending downward for decades. Unlike Japan, however, US Treasury rates have never fallen to or below zero. The US also faces the challenges of an aging population and heightened global competition. Yet, compared to Japan, the US benefits from a more open economic system, which fosters faster population growth, greater innovation, and dynamic capital markets fueled by the influx of talent from around the world. According to financial experts, this is one of the reasons for the recency bias that continues to grip Americans, particularly policymakers who have repeatedly refuted warnings that the US is about to become the next Japan. In a recent interview with Julia LaRoche, legendary investor and financial commentator Rick Rule discussed the ongoing turbulence in the Japanese economy and highlighted exactly why he believes the United States economy is next in line. With a debt-to-GDP ratio of over 130% and growing, Rick believes the US is tilting right on the edge of a sovereign debt crisis that many are unfortunately unprepared for and completely oblivious about. We will present clips from Rick's interview with the Julia LaRoche Show. But before we do, please take a little time to like this video, subscribe to the channel, and turn on the notifications bell for more videos like this. Thank you and enjoy the video.
Now, we've had a little wake-up call over the last week, and I think these wake-up calls are very useful and in fact wholly beneficial, although they're painful. The unwinding of the Japanese carry trade has been baked into the market for 30 years, but because it didn't happen until it didn't happen, nobody cared much. The idea that Japan could run up very large current account deficits while still manipulating the interest rate lower and could deliberately manipulate their currency lower to increase exports gave rise to a circumstance where big Japanese banks could borrow money at a very low cost in a currency that was guaranteed to go down and reinvest that money at higher interest rates in a currency that, at least relative to theirs, would go up. That can't last. Nor can government debt at 300% of GDP last. But because it went on for so long, because there were 3 decades of built-up savings in Japan, people didn't pay attention to the warning signs until the trap was sprung. This happens again and again and again. It has been said there's only 7 basic lessons of investing. The difficulty is that you need to relearn all of them in sequence. Once a decade. And so I think it's important that people look at the events of last week and understand how forecastable they were, and understand that there are other lessons in the market too that we don't pay attention to until we have experienced them. And that is very useful. When people look at the US economy, they say, well, why should American debt to GDP at 120% be problematic? The Japanese ran for a long time, over 200. It went on until it didn't. The Japanese individuals had much higher per capita savings than the Americans do, and hence they could afford to be stupid for longer. But when the string plays out, the string plays out. Julia, I remember, and you'll understand where I'm going with this in a while, being not unsophisticated financially myself, driving 20 years ago, and seeing a big billboard on my right, on the right of the freeway, that said, borrow 125% of the value of your home. Bad credit, okay. And I remember as a lender thinking, I'm not sure this works out okay. But I didn't correlate that complacency with the crash of 2008, although they were directly correlated. It turns out that people don't pay too much attention to warning signs that are statistical until the trap has already been sprung. I'm not suggesting, Julia, that people should go out and look for catastrophe and, having found it, curl up in the corner in fetal position and do nothing. All I am suggesting is that people begin to construct their portfolio in a way that ensures them against contingency.
Everything is fine until it isn't. This phrase perfectly describes the US economy and the trajectory we've been charting since reckless money printing, unchecked government borrowing, and spending became a major part of our monetary policy in 2008. While the United States' status as the issuer of the world reserve currency and the world's largest economy affords us some leeway, history shows that the chickens will eventually come home to roost. It happened with all other superpowers that dominated the global economy at some point in the past, and it's unbelievably stupid to think it would not happen with the United States, particularly given that we are doing almost everything in our power to lose that status. We are increasing our already massive debt by $1 trillion every 100 days, with trillions of dollars in deficit, almost another trillion in interest expenses, and almost another 200 trillion in unfunded liabilities. On top of that, we are weaponizing the dollar, alienating countries that have held US treasuries for decades. Yet a large percentage of Americans believe all is well and good. Let's get back to Rick's video.
2 risks and 1 opportunity. The risk is the fact that most people believe that they enjoy a real yield on US dollar denominated deposits. When people in the United States look at inflation, and when people in other countries look at US inflation, they rely on the CPI. The slogan for that is that it's the CP lie. It doesn't measure the deterioration of the purchasing power in US dollars. It doesn't include, as an example, food or fuel. Julia, if you look at me, you can see that I like to eat. So an inflation index that doesn't include food is of very little use to me. But more importantly, it doesn't take into account tax, the largest household expense of most working households in the United States. When I calculate the increase in the price of the goods and services that I use to live, including government, which is neither a good or a service, what I see is that the purchasing power of my earnings and my savings is declining at 7.5% compounded a year, not 2.6. If I juxtapose that with the yield available on my savings in the U.S. 10-year Treasury at 4.3, rather than earning the delta between 4.3 and 2.6 as a real yield, I'm losing the delta between 7.5 and 4.4. What that means to me is that the natural direction of interest rates is higher, or the natural direction of equity prices is lower, and that people need to pay attention to that. That's, I think, really the first thing that I look at. The other is related to it. It's the inexorable increase in government debt. People don't react to government debt because it doesn't affect them until it does. The financial crisis of 2008 was solvable by the federal government because there was faith in the federal government, and there was faith in the federal government having the firepower to extinguish the problem. On-balance sheet liabilities of the U.S. government in 2008 were about 25% of GDP. On-balance sheet liabilities of the U.S. federal government now are 120% of GDP, almost 5 times higher. That is concerning. It doesn't concern most people because they're more attracted to narrative than arithmetic. But people need to pay attention to arithmetic. Even more challenging for me, though, Julia, is the incredible expansion of the net present value of unfunded liabilities in the United States, entitlements. The Congressional Budget Office estimates that over $100 trillion in promised entitlements, Medicare, Medicaid, federal pensions, military pensions, exists today, which means that we're $100 trillion net present value behind the eight ball, and nobody pays attention to this. We're trying to service $35 trillion in on-balance sheet liabilities and $100 trillion in off-balance sheet liabilities with a budget that is itself in deficit $2.5 trillion a year. We don't care because the trap hasn't been sprung. The Japanese didn't care until last week.
What we are witnessing right now is the complete collapse of society. Younger people are working more jobs and earning less in terms of real wages, which is why many are so depressed and completely opposed to starting a family. This is all a result of dollar devaluation, which is expected to worsen rapidly in the coming months and years. Several experts have warned that believes 2024 is the year of the financial endgame, an impending event that experts believe will spell doom for the current monetary system and all fiat currencies, including the US dollar. Last September, the US national debt hit $33 trillion for the first time in history, drawing a lot of criticism from financial experts across the board. It has grown by another $2 trillion since then, and the national debt is now $35.15 trillion. Yet, the massive and rapidly growing debt is just one of the many economic challenges the US faces. According to Rick, the time of reckoning is here, and we have only one financial crisis left before a severe recession and the final round of money printing by the Federal Reserve. However, there is a silver lining for gold and silver investors. The rockier things get, the faster people move to protect themselves by buying, hoarding, and possibly using gold and silver in transactions if the dollar becomes worthless. Of course, that means higher gold and silver prices and adequate protection for everyone who has been preparing for this scenario for years. Please share your thoughts on Rick Rule's interview and predictions for the US economy in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.